Welcome. Thank you, everybody. Great to have this opportunity to first meet everybody here. I hope I have a chance to meet as many of you as I can. I'm looking forward to attending more of these Opus events. So Lou, thank you for again telling us about the organization. I look forward to meeting more of the Opus members. We do more of these events.
And more deals.
Yeah, exactly. So just very quickly before I'll let the three of you introduce yourselves. I'm not going to try to bother introducing, which is something that you guys can do much better than I can. But really quickly about Cascadia Capital, as Eric mentioned, our firm is headquartered in Seattle. Most of the folks that we work with are business owners, the middle market companies. We do a little bit on the buy side, but most of what we do is represent business owners that are looking to either raise capital or affect the partial or full sale of their company. Our firm has been around since 1999. As Eric mentioned, we've opened this office here in Los Angeles. Most of what Eric and I are in front of is the automotive aftermarket space. I started this practice in 2013. Really was a function of me combining, my passion and love since I was a kid for vehicles with, the only thing I know how to do. And so we've formed this automotive aftermarket practice. And in the last 24 months, we've now represented 4 SEMA members. We're covering many other companies within the aftermarket and hope to bring many of these companies to market at some point. So with that, I will let Ed and Scott and Chris introduce themselves and then we can get started.
Great. So I am Ed Moss. I know a lot of you. I'm with Lincolnshire, which is a middle market buyout firm headquartered in New York. I joined 11 years ago to open up a Los Angeles office and cover the Western U.S. So this fund's $835 million. It's an institutional fund, endowments and pension funds. In this fund, we've typically been doing kind of things that are low teens of EBITDA up to 30 million of EBITDA. We do things throughout North America and in Europe. We have an Italian portfolio company, a Dutch portfolio company. We like consumer products in general. We're very broad-based across the industrial space and manufacturing. But within the automotive space, in addition, and we'll talk more about, we own Holley and MSD, which are specifically in the performance aftermarket. But we also own a company called Amports, which is automotive logistics. So we've done well and have liked that space. And also in consumer, we've done quite a bit because that overlaps with today's topic. In consumer, we've also done various sporting goods. We've owned Prince Tennis Racket, Rydell Football Helmet Company. We currently own True Temper Golf Shaft Company. And in this consumer space, we also recently, a year ago, sold Patty, a scuba diving education company. So that's us.
Cool. I'm Scott Webb. I am the operator in the room, or one of the few operators. I probably know none of you. Currently with Pilot Automotive, a company that Paul worked on a transaction that closed in June, I think, although we had a protracted due diligence.
Not our fault.
Call Charlie. Our company, sort of middle market, we design things in California, we make them in China, we sell them to AutoZone, Advance, O'Reilly, Walmart, Pep Boys. We also have a little electronics business whereby we make portable power, cell phone accessories, stuff like that. We now sell into AT&T, Target, and a number of other, everything down to Fingerhut, if you can imagine that. I've been with the company for about a year. I came along with the transaction and actually co-invested next to the PE. Prior to that, I spent about 8 or 9 at Pep Boys. I was the chief merchant, had marketing, merchandising, supply chain, digital, online, the whole works there. And then prior to that, I spent 22 at AutoZone, the last 15 of which in a merchandising capacity. So I've been on both buy side and the sell side. And love my job in Southern California. It's a hell of a lot better than Philadelphia.
Especially now.
No kidding.
Yeah.
Thanks, Scott.
So my name is Chris Sheeren. I'm with Huron Capital Partners. Kind of set up a little bit like Ed's firm, except maybe just a little bit smaller. Our current fund is $500 million, and so we're investing in companies with 5 to 20 million of EBITDA. We'll go anywhere in the U.S. or Canada across 4 general categories, industry categories, which are consumer, healthcare, business services, and what we call specialty manufacturing, which is anything that's not too heavily industrial or heavily cyclical. Within the automotive aftermarket, we have had 3 investments. Most recently, we closed an investment in December, a company called Drake Automotive Group. We'll probably talk a little bit more about that later. That's Huron in a nutshell. Also, we're based in Detroit. I failed to mention that. One quick question, Paul, at the risk of kind of hijacking the conversation here, just so we can get a sense of kind of who's here. How many people have either invested or worked to some degree in the automotive aftermarket? So probably less than half, right? So, Paul, you made a comment about SEMA. Just for the benefit of everybody here, you'll probably hear that term. SEMA and Apex are the two, and they occur at the same time. It's the big industry trade show. It's the second, I believe it's the second largest trade show that Vegas has in a year behind CES. So it's a huge, number 3?
Actually, isn't it bigger, Scott? I think there was 140,000 registered visitors last year. There, huh?
It's big, is the point.
Yeah,
So you'll hear that. You may hear that term thrown around, and that's just kind of an industry shorthand.
How hard it is to get a ticket to get into SEMA.
All you got to do is call me.
Scott's on
The
the
hard part about
industry
SEMA-
association. So
If any of you are planning on going to see them, it's a great event, but just make sure you have comfortable shoes because it's enormous.
And enough memory on your phone to take a lot of pictures.
That's right. But thanks, Chris. That's really helpful. In fact, I'm glad you did that. So we are going to mention SEMA quite a bit, and that is the industry association for the world that all of us play in the aftermarket.
Do you want to give some color as to the size of the market?
The size of the market?
So SEMA is roughly 30-ish billion, is that correct?
I think it was 60 billion.
That's with tires and wheels.
Okay.
And then the other side, which is, they call it the Auto Care Association, 270 billion at retail is through service or do it for me. So think Firestone, the parts, brake pads and stuff that go through there, Goodyear, or the independents. And then the 70-something billion is where the customer actually goes to the counter of an auto parts store and buys something and takes it home, whether it's a pair of brake pads, a battery, or floor mats or seat covers. And so that industry, they call it the repair and maintenance side, is 340-ish. And then Sands Tires and Wheels, the SEMA, which is Specialty Equipment Manufacturers Association, that's all the customization, personalization, and performance, and that's 30 plus the other 30 of tires and wheels.
Yep.
So to give you some top-line context.
And if anyone here is interested, so our firm has put together a industry report, an automotive aftermarket industry report. I'm happy to share it with anyone here in the room. Just come find me or Eric, and we'll email you a digital copy of our 2016 annual report for the industry. And it's going to have a lot of the metrics that Scott just mentioned there. So, great. Well, let's get started. We've got a lot of interesting topics here to cover. I'm going to try to get through most of these as we can. So the first topic we're going to talk about is something more kind of general, broad automotive versus kind of the aftermarket. One thing I think that we all have in common, whether or not we've participated in the aftermarket or we have an interest in this space, is that we all drive cars. And I think everyone here has noticed and seen, this unbelievable amount of innovation in technology within the vehicle. Everything from car sensors to backup cameras to lane change assistance and automatic braking and self-driving cars and infotainment and connected cars. I mean, it's amazing how much technology is going into the cars. So one of the questions I have for the panel here is, what are your general impressions of the new technology, and what trends do you see kind of going forward that will influence driving behavior? And then secondary to that is, what opportunities and threats do you see for the aftermarket players with all of this technology and innovation that we're seeing in the vehicle.
Oh, you gotta look at me. I think from a consumer behavior standpoint, I think we're starting to see it already. I think people now live in their cars. We actually have a category within the space that we've all played in called interior organization, and just for instance, how you live inside your car. Many of the retailers are now calling that literally how I live in my car, and so it's really changing, and millennials are actually doing it more so than sort of old farts like me, which is how do I stay connected in my car, whether it's PDAs, whether it's tablets, power management, all that sort of thing. That's sort of the behavioral change. I think the most important conversation, and we're having this conversation at our industry association level, which is sort of who owns the data. And so about 3 or 4 years ago, the association was successful in getting legislation passed through Massachusetts that basically stopped the OEMs from locking the hood. So you might know that as the Right to Repair Act. We spent several $1 million, tens of millions of dollars fighting the OEMs on this. And what they really wanted to do was they wanted to keep the repair manual and the instructions on how to fix the car to themselves. And they didn't want to give that to Lee at Leach Tri-State Auto. They also didn't want to give it to Firestone. They just basically wanted to have that Bible, if you will, resident only at the Ford dealer or the Chevy dealer. And we were successful in getting that started in Massachusetts, and now I believe it's pretty much federal to where the OEMs have to provide those instructions to fix the car to the automotive aftermarket so that the consumer can choose who they want to have repair their vehicle. The next fight that we're talking about is if you think about connected car, cars will become Wi-Fi hotspots, okay? They already are. GM OnStar talks to GM and sends messages all the time, whether you've got a throttle position sensor that's failing, or whether you push the panic button, or whether you want directions to McDonald's. It's sending that communication, and the real question that everybody now is asking, because the next generation of communication will be, people will be surfing the internet. Kids will be in the back, and they'll be streaming something on Netflix, okay? Or they'll be surfing something that they, finding directions here, or looking up their stocks, or even logging into their Morgan Stanley Smith Barney account. Who owns that data? And who owns that browsing pattern? Now, it's going through the OEMs, but they're using the telecoms, they're using the Verizons, the AT&Ts and whatnot. And so they're now fighting for that data stream because they all want to use it to market. They want to use it to sell to the insurance industry. They want to use it to sell to consumer brands. And I think that's going to be the big sort of fight as to whose data really is it. And our position from the association standpoint is it actually belongs to the consumer. And nobody really has a right to that. And so how do we lock that down so that there is security and nobody else can access that and then use it for some purpose for profit or for some malicious intent or whatever. And then the other big thing is, I think everybody's sensitive to security nowadays, especially with cell phones that the government wants Apple to open up. How do we lock the communication stream, and how do we protect the the security of that data transmission that's coming in and out of the car? Detroit has proved that they can build a car. Japan has proved they build a car. But we as an industry are concerned that they're not necessarily the data and technology experts. And so if they don't partner with somebody who really is a data and technology expert, there could be risk there.
So you can see why I was looking to Scott to do the opening remark. He has a very broad and deep perspective on this. For us at Holly, and so we own Holly and MSD, and is probably a much more narrow answer to Paul's question. But when we purchased Holley on this question of technology, Holley is famous for their carburetors. Well, today cars have electronic fuel injection. And so, and our market is the hobbyist, enthusiast, professional that, you know, works on their car, the gearhead. And, you know, there were questions when we bought Holley over 3 years ago, what this was gonna look like in terms of, as cars were, you know, being, you know, less mechanical and more computerized. What did that mean for somebody that wanted to work on their car, and what did that mean for our electronic fuel injection product, which was not only, you know, a much more technologically sophisticated product, but a much more expensive product. And interestingly, for us, we found for that hobbyist, we've had a great transition. They'll still go out and buy this expensive electronic fuel. There's still a lot of folks working on their muscle cars and dealing with carburetors, but we found that the hobbyist has transitioned into that more technological arena.
Yeah, certainly, you know, the number one warranty cost or the number one quality failure in any new vehicle is electronics. And that's really the thing that drives the OEMs nuts, because, you know, consumers want all the latest gadgets and technology in their cars. You think about the content that is in a car now versus, you know, 15 or 20 years ago. I mean, it's really amazing for basically the, I mean, prices have crept up a bit, but the amount of just technology and capability within a vehicle now versus 20 years ago it's unbelievable, really. But what's come with that is a cost of just, you know, lots of bugs. You know, new technology has bugs, and certainly that's created more work for the dealers than anyone else, I suppose. But it's interesting to hear your perspective on enthusiasts kind of embracing this. A couple of thoughts, I guess, giving you the Detroit perspective here. Although we generally don't invest in the OEM supply chain at all. It's just too cyclical for us. But living in Detroit, you can't really get away from it. So a couple of things. I was at the North American International Auto Show about a month ago in Detroit, and all the talk is autonomous vehicles and driverless vehicles, and while it's very interesting, it's still a number of years away. I don't think that's going to really impact the aftermarket anytime soon. But I'll tell you that the OEMs, that's all they can talk about now. So at some point there's going to be that will ripple through. But I think we're a little bit ways off there. The other thing is we're in the midst of record new car sales right now, and so that's going to generate some work. You can argue. Scott and I were kind of theorizing about this a little bit earlier about how, when does that work, and when do those cars turn over? One of our investments is a used car auction business, a company called Accelerate Group, and it's really a dealer-to-dealer model. They're selling from they're kind of helping used car dealers liquidate their inventory to other used car dealers effectively, and so they kind of see these there's a little bit of a lag from new car sales to a few years down the road to those volumes that kind of this current $17 million volume level, that's going to come down at some point. You can argue where we are in the economic cycle, but at some point that's going to tail off. But that's going to kind of work its way through like the old golf ball through the snake. So if you think a few years down the road when these record volumes start coming off warranty, and also just start needing repairs as they do, as cars do over time, that's going to arguably increase activity, at least in the repair and maintenance side of the aftermarket, a few years down the road. Just a general question here, and Paul, I'll look for you to the answer. But how old do you suppose the average age? What do you suppose is the average age of a vehicle on a car in the U.S. today? Anybody want to guess? No, you're not. You guys aren't allowed to answer just yet.
8 years.
7, 8 years?
Well,
there's somebody's a lot closer. Yeah.
It's 11 and a half, right?
Yeah, it's in that ballpark. Yeah,
And that's the highest it's been ever.
Yeah, which kind of makes sense, right? I mean, quality is improving over time, and they're lasting longer. But the cars, on average, are a lot older than people in our demographic think they are. We all, generally, folks in this room are doing relatively well financially and driving relatively new cars. But the rest of America is driving, on average, 10, 11-year-old vehicles.
Yep. The average consumer spends $893 a year on their car, not including gas and insurance and car washes. That's just repair, maintenance, and accessorization. $893.
You're so above average.
Yeah,
You spend more than that?
Yeah, a lot more.
You live in West
You
LA.
drive a Volvo?
No.
Perhaps the Alfa Romeo was not a good choice.
Maybe the
When those
MG.
Aston Martin repair bills add up.
The MG.
The other kind of current, I guess you look at the last year that I think is really relevant, is miles driven were up meaningfully in 2015. That's just the kind of the average or the total number of miles that all vehicles drive in a year. Doesn't really usually move that much year to year. It's correlated with gas prices, certainly, with gas prices having been down. Miles driven were up more in 2015. You know this number better than I do, Scott, but more. It's been a long time since they've jumped. They've crept up a little. They were really flat for a number of years until about
It's the
beginning of
highest
13.
point ever,
Yeah,
recorded history.
until about 13. They picked up 13, 14. Then 15 really jumped up, grew what 4 or 5% or something, which year over year is just a really significant gain. So, and that certainly bodes well for anybody who's in the repair and maintenance segment.
I think the overriding comment is because of low gas prices, because of increased consumer purchase of new vehicles, and because of more miles driven, I think this aftermarket is going to be a nice place from a growth standpoint for probably the next 3 to 5.
Yeah.
You know, you've got AutoZone and O'Reilly posting big numbers from a comp standpoint, quarter after quarter. Granted, there are some underperformers. You know, the people that aren't public, the traditional groups, if you sell to them, you know that they're doing well, even though they don't put up numbers publicly, they are doing well. So, you know, the repair business is growing at sort of a mid to low single digit, and right now the DIY business is doing the exact same thing.
Yeah, it's a good time. And it's a good time for consolidation, which is our next topic. You know, we're all in the middle of this, but there has been, in the last few years, tremendous consolidation of automotive aftermarket companies, whether it's, you know, service chains, dealerships, to parts companies, to accessories companies, you name it. Again, the folks up here, we've been all kind of in the middle of it. And one of the questions I'd like to ask Chris and Ed is, you know, what do you think? I mean, we've talked a little bit about it, but you know, what is the driver? What is the main interest of institutional principal equity money in this space? You know, I know the metrics are all real high, which we just alluded to, but this has been going on for 4 or 5 years, where just month after month you're seeing, you know, a very prominent, well-known SEMA member getting acquired by a private equity fund. So maybe you guys can speak to what you think your firm's interest in the automotive aftermarket has been, and maybe you can talk to if you think going forward it's going to continue having that strong interest, or if it's going to abate at all. So, and certainly, Scott, if you have any thoughts on that from your side, you know, feel free to chime in.
Ed, you want to start?
Sure. So when we bought Holly a little over 3 years ago, you know, ours is very specific, again, because we're around the hobbyist, enthusiast, professional driver market. It's driven by, you know, consumer discretionary spending. Now Holly had, and Scott and Paul, who are much more historians of this industry than I am, can talk about some of the ups and downs that some of these companies have had historically. But Holly was coming out of a period where they had been, had gotten away from focusing on the performance market. They'd gone to the OEM market with you know, focusing on diesel and teeing up Caterpillar as a big client, completely different from, you know, the hobbyist working in, you know, on his or her car. But they had reorganized themselves and were on this track, and it was moving very well. And as I mentioned at the beginning, we like consumer products, and especially these, like, I'd say there's a little bit of similarity between sporting goods and folks that work on their cars. There's a great enthusiasm around that. So I think for us, first, so we saw stability, we saw a good trajectory, we saw good, strong consumer discretionary spending coming out of the recession, and then Paul referenced, consolidation. So last fall, we acquired a company called MSD, which basically has the same customer base. Ignition systems versus, carburetors and electronic fuel injection, which are the drivers for Holly. So, but same distribution channels and same end market, and we weren't in there to change anything. So I think it's the stability of the market, the growth that we've seen, the fact that again for us, one of the things we looked at very closely was the folks that want to tinker in their car. We looked at that demographically from every angle we could think of, because there were some people in the firm, such as me, who initially thought, well, isn't this a sunset situation? Well, my partners who were really working on the deal, I was, certainly was looking at it, but I wasn't working on the specific deal when we did it. We're very convinced and provide a lot of data that it's continuing. It's not just, old folks who are gonna kind of die off and the tinkering is gonna stop. Continues to be great enthusiasm for it. And in consolidating these companies, we're not playing with the brands. These are brands that have great dedication by the people that buy them, and and these are substantial companies. These are not mom and pop companies. They're high, very, very, well over. They're double-digit EBITDA companies, so with the very professional management, I think is to Paul's point about what attracts PE. That's another element that attracts.
Yeah, I think there's no question. The last 5 or 6 years, the private equity world has woken up to or discovered the automotive aftermarket. And for us, and like you guys, it's a huge market. It's very diverse, and we're kind of a pretty good example. The 3 investments we have. One was a brake pad repair parts business. One is an enthusiast parts business mostly for classic Mustangs, and the third is a used car auction business. Those are all pretty different businesses, but they're all within the aftermarket. And there's tires, there's car washes. There's just so many different sectors to play. To me it doesn't necessarily directly answer your question, but to me it's why I'm fascinated by it, just because there's just so many different elements to it that a lot of different aisles to shop if you're an equity investor. But the biggest thing for us is it's just a pretty stable market, generally speaking. You just don't really see the ups and downs that you do in other industries. And again, we're sitting right in downtown Detroit, and we've seen it. We've always kind of carefully avoided the OEM supply chain because it's so cyclical, and we kind of somewhat smugly chuckle when we see these equity groups coming in from New York or LA or wherever. Pick your city that isn't Detroit, thinking we can we got this industry figured out, and it just inevitably the next downturn they're leaving town with their tails between their legs, because it cycles so hard. Yeah. It's just a really and on top of that you get doing business with especially the domestic OEMs is not a pleasant experience. They're very, very difficult customers. And the aftermarket, very, very different. Although, dealing with Scott's former employer and some of the other retailers is not easy. Certainly, I would argue they've taken a page out of the Detroit OEM supply chain management page book. But just beyond that, the revenues are generally pretty, depending on where you are. I mean, if you're an accessories business that's tied to new car sales, well, great. Most accessories are bought are bought and put on the car within the first 6 months of the purchase, and so times are great for you now. But if your accessories are mostly tied to new cars, well, then you're going to cycle too. But setting that aside, most areas within the aftermarket are pretty non-cyclical, and to me that's the single biggest, most attractive thing about the market. In addition, as you said, it's margins are generally pretty decent. You're kind of allowed to make money by your customers, and so that's okay. But again, it's really just kind of the long-term sort of steady nature of the demand that's exciting for us.
Yeah, from our perspective, it's interesting, and Chris and Ed, you won't like hearing this, but when we started doing processes for automotive aftermarket companies in 12, 13, we don't run broad processes at our firm, and so we kind of pick people that have been active in the space and we know could do a deal in the space. It was 20 people, right? And now we just ran a process where we're speaking to now 70 people, right? And just the list gets bigger and bigger of, New York, Boston, everywhere, in the country. You've got private equity firms that now have portfolios in their funds of aftermarket companies. And so anyway, it's certainly becoming a more broader world and versus a specialized world, which I think is great for us, but more difficult for obviously all the different principal investors. So as a secondary question to that same subject, and you alluded to the hobbyist, enthusiast nature of companies like Holley, companies like Edelbrock, companies like B&M Racing, Bully Dog, K&N Filters. And all these companies are beloved, well-known enthusiast brands within the automotive aftermarket by gearheads and grease monkeys and people that love to work on their cars. And by the way, every one of those companies I mentioned is now owned by a private equity firm. So, I have spoken to some of the gearheads at SEMA that month after month they see these beloved brands get acquired by private equity folks. And you can read the blogs and you can hear their feedback, and their concern is, oh geez, these are such great brands and now they're getting acquired by some guy in New York or some firm in New York that doesn't know how to keep the authenticity of that brand, right? It's a perception that you'll hear sometimes from folks within the industry. And so here's a great chance for maybe you and Ed to talk about how it is that you do keep the authenticity of a brand like Holley that's so well beloved. And maybe you can speak a little bit to that.
Sure. The last thing we want to do is mess up the brand. And I think one of the things Paul's highlighting is something that's a generic issue that private equity has is, 99% of us are partnering with management. We're not hostile. We're not in there to run the company. We're partnering with a well-run company that we think we can maybe help it run better. But at the very least, we're getting liquidity to the seller. We're not there to take it apart. And this audience knows that. But I think that goes to the person on the street. Typically has a kind of a misconception of what private equity is about and how we operate. For us, the CEO's been the CEO Tom Tomlinson's been there, I think it's 10 years as CEO of Holley. He's not going to tinker with the authenticity. But it's something that we're sensitive when we, for instance, even though it's a different company, with our scuba diving education company, Patty, we were very careful and management was very sensitive when we acquired Patty. We put out no news releases because that relationship between the scuba diving instructor and it's especially the instructor, but also the recreational divers. They didn't want people think of Patty in the same way the enthusiast thinks about these brands as a very warm and authentic kind of, and so we just didn't put out anything about the acquisition having happened. People can find it out, but
There's going to be a tombstone for the banker, right?
I'm always the tombstone from the banker. But the person on the street theoretically doesn't really see the tombstone. And what about you, Chris?
Yeah, again, I mentioned previously, we recently invested in a company called Drake Automotive Group, and Drake is also in the enthusiast market. And so there is it's a challenge because Scott Drake founded the business in 1988 and built it out of the back of his truck, and great guy, great all-American success story. But Scott's 60-ish and wants to slow down a little bit, and so it's certainly important for us. And Scott's going to stay involved at kind of a chairman sort of level. And it's certainly very important for us to make sure that he's still kind of the face of the company and he's going to be out there because we're sensitive to that. You don't want somebody to think, oh gosh, Drake's been sold and so that company's going to go downhill. I mean, there's no reason for them to think that, but that sometimes unfortunately is the assumption or the perception. So yeah, absolutely, it's important for us to keep Scott front and center and making sure that customers see him visibly. I mean, the company's really selling mostly to distributors as opposed to direct to consumers, but consumers still do know the Drake name. And so, yeah, there is some sensitivity there for sure. And again, like Ed said, why would we want to risk screwing that up? I mean, that would be silly. The flip side, or maybe the little bit the way we're handling it a little bit differently, because the plan for us to grow this business is to acquire other kind of like businesses or like brands that are, Drake is kind of the big name in classic Mustangs. But there's similar groups that are targeted at classic Porsches or pick your sports car or your muscle car. Our plan and our vision is to buy several of these companies and put them under one umbrella. And so we do need to kind of advertise that Huron has recapitalized Drake and we will be looking to do acquisitions. Scott's very excited about this too, although he's not going to be running 100 miles an hour working 80 hours a week anymore. But he'll still be involved, and again, it's important that we let the world know that we're not just trying to make this some sort of cold corporate monolith, and Scott's still here, and the people that the products that people have been buying will continue to be there.
Yeah, I mean, to be fair, I mean, I think that a lot of this perception is misplaced, right? But there is a perception out there, especially when you read a lot of blogs. But yeah, absolutely. I mean, from the experience we've had and so on. But maybe the proof is in the pudding. So we have an entrepreneur, operating exec here, who just went through a transaction. Why don't you tell the folks here what that was like? There are probably some advisors here that are working with business owners that are contemplating their own event at some point in time. Maybe you can give some guidance on, or some suggestions or recommendations on how to prepare for a process. And then maybe you can also speak to, the relationship you've had with the private equity partner and what that partnership has been like so far in the last 6-8 months.
How much time do we have? I have a great relationship with our PE. Unbelievable. I didn't think it would happen. It was totally to my surprise. I will tell you that I've got I have a lot of deep first-hand knowledge about PEs. I went through 3 failed buyout transactions when I was at PEP. Very famous, very publicized crash and burns. I think a neighbor over here paid us $50-something million in a cancellation fee, which is all public knowledge. So I came into the thing, sort of like this a little bit, okay, and I negotiated that way as well. My CFO now and the founder of our company was less involved in the process than myself and the CFO. I think we got to a great spot. I think what I learned through the whole thing is, and I knew this all along, I just sort of forgot it every once in a while because you argue over little stuff. At the end of the day, it's about shareholder return. And, so I worked for 30-something years driving shareholder return for shareholders of public companies. And so that means stock price appreciation, okay? PEs just have a different way of getting a shareholder return. And if you figure out how to do that for them, they're going to be happy. And that comes with a sound business model, a committed management team, and a track record of execution. And if those things are really pretty easy as long as you don't have a broken business model. But I think probably the folks that are in this room aren't raiders, and they're probably interested in viable businesses rather than broken businesses. So I mean, I'm very pragmatic about the relationship. I think the relationships can be really, really good. I have a lot of operational friends in the business that are PE owned or PE invested. I've heard some war stories, but for the most part, I think if you execute and you deliver on your commitments, then everybody's happy. And the other part of it is making sure that your interests are aligned, and so that the management's interest and the sponsor's interests are aligned, as well as those commitments that we make to each other.
Yeah.
Once everybody's happy with that and there's transparent, honest communication, I think it works. I think things break down when there isn't transparency in communication and interests aren't aligned, and there isn't clarity as to what the end game really is. But I think it's about shareholder return. So, my sponsor, I talk to him every other week, maybe. I've learned that this is a business where y'all like to text, and so if you want to know what Monday's numbers were, I'll text you Monday's numbers. It's fine.
Would you say that the relationship with your PE basically boils down to EBITDA growth? Like if you hit your EBITDA number, everything is rosy, and if you don't, then everything is not. Not to put words in your mouth, but
No, I don't think that's the case. So I hit my number. I always hit my numbers. Okay. I was trained by this fella named Eddie who crashed Sears. Okay. And
Where's
he
he
taught
at?
me the discipline, Lampert. And he
Okay.
taught me the discipline of hitting your numbers, right?
yeah.
I think it's more than just EBITDA target or not. I think, these firms generally have a holding period of 3, 4, 5 years, depending on, sort of their investment strategy. I think you're allowed to miss if something happens, okay? But I think the more important conversation, if you miss a metric, is what are you gonna do to fill the boot? And so, I view it as the firemen that are out on the corner filling the boot with donations for the charity.
Mm-hmm.
If you miss, you have to figure out how to fill that boot and get back to your commitment. Just is what it is. And if you miss a quarter or an annual number, then it's not about explaining what happened, it's about explaining what you're going to do and having sound tactics that are believable so that you can make it up. I think that's the difference.
Yeah, this whole concept of a partnership, I mean, it's something that we get from our business owners that we cover. They ask me, well, I'm not looking to, sure, I'm looking to diversify some of my wealth. Many of these business owners have their entire net worth, in the company. They'd like to diversify, they'd like to take some chips off the table, they'd like to have some liquidity, provide some security for themselves. But in most cases, a lot of these business owners aren't viewing this as a sale, right? They're looking for a partnership, a true partnership that can help them grow this business, partner with the company, and a lot of that is a function of, the equity role going forward that the private equity firms are so encouraging to do, right? And so a lot of the times when we sit down with these business owners and we explain this nature of a partnership, then it just makes more sense. The owners start to feel that, okay, it's not necessarily like I'm giving up my company, I'm saying bye-bye, and I'm gonna go play golf for the rest of my life. There are some owners that are like that. But in most cases, the deals that we've been involved in, like with Scott and so on, there's a lot of participation both in equity and in the operational role going forward. So anyway,
I'll give you a contrast just for grins. I spent the last 10 years essentially answering to an activist shareholder board of a public company.
Must have been fun.
I am having a hell of a lot more fun today.
After that, root canal would be more fun.
Trust me.
Yeah.
Trust me. And it comes down to having aligned interests and having transparency and open communication. So, I text my PE, all kinds of stuff, and he, it's a good working relationship.
well, unfortunately, I think we're out of time. Thank you, everybody.